Hey, everybody.
Hey.
Can you all hear me?
Yep.
All right. Holly, thank you for troubleshooting. Appreciate it very much. Thanks for making time. I know everybody's busy and certainly an interesting market that we're in, but whenever we have significant changes to guidelines that affect you, the realtor, we want to make sure that these are front of mind. And if you work any condo business, regardless if you're a brand new agent or if you're an experienced agent, these are guidelines that have already started to affect a lot of people. So I'm going to go ahead and share my screen here. And we are going to slideshow this thing from the beginning. All right. Can everybody see my screen?
Sure can.
All right, perfect. Now, PowerPoint's not, I will tell you, a perfect, I'm not great at it like Liz is. I'm just trying to get this to go full screen. There we go. All right, here's what we're going to do. And do this. All right, how about that? Is that full screen for you all?
Yes, it is.
Perfect.
Yep.
All right. So let's get into some new rules and regs that have taken place in the finance industry when it comes to condo mortgages beginning this year. Where has this all stemmed from? This stemmed from a condo building collapse June 24th of last year in a Miami suburb called Surfside, Florida. This was big news at the time. This building collapsed at 1:14 in the morning. So in the middle of the night, almost 100 people were killed. Just last week, families of the victims of this condo collapse reached an almost $1 billion settlement with a number of different parties that were adjacent to this particular building, both its construction, its management, and the insurance on it. This ended up being the third deadliest structural collapse in U.S. history. So obviously something that when you look at those two other, the two that are above that on that list when it comes to structural engineering failures, they happened more than a century ago. So to see this happen in the year 2021 was quite shocking. Why this building collapsed is because of some concrete issues and the geographical location of this actual condo building. They determined that when this building was constructed, the pool deck was not appropriately constructed and that there were significant concrete failures around the pool deck, which was underneath, for the most part, this particular building. In 2018, there was a study done that was essentially, hey, there is maintenance that needs to be done on this property. It's been deferred for a significant amount of time. And we think that there needs to be some significant structural work done to this Surfside condo building to get it compliant and also ensure structural safety. Interestingly, in certain Florida counties, Miami-Dade County, for example, all of these condo buildings have to go through a recertification process every 40 years. So the building was ready to go through that recertification process once these repairs were done. The HOA, and you see in this third bullet point, had taken out more than a $10 million line of credit to start these repairs when it comes to structural integrity. They were going through this process, if you look back through board meeting notes, et cetera. But ultimately what happened was nobody likes a special assessment, right? So they were trying to figure out how are we going to satisfy the unit owners and also get this construction done, get this property more structurally sound at the time that it collapsed last year. So what happened? Ultimately, as a result of the collapse of this building and this tragedy, the government-sponsored entities, which is Fannie Mae and Freddie Mac, rolled out new, quote, temporary lending requirements for all condos across the United States. They said, hey, if you are going to sell a condo, if you're going to finance a condo, and the loan is going to be sold to Fannie Mae and Freddie Mac, which a huge portion of loans in the US are, then we have new, more stringent guidelines that you are going to meet as of the year 2022. Now, are you all familiar with condo questionnaires in general? I'm sure you probably are. They talk about a number of different things like investor concentration, whether the property is in litigation. It'll talk about budget guidelines. The condo questionnaire has been around for a long time, but now Fannie Mae and Freddie Mac have added a second condo questionnaire, which is Form 476, that is all about safety, soundness, structural integrity, and habitability. So I'm going to hyperlink to this if I can. This is what this looks like. So on all condo purchases, the lender is required to get this filled out now by the HOA. And you can see this is very different from your standard condo questionnaire. It's going to talk about the last time that a licensed architect, a structural engineer, building inspector was out to the property, talking about things like recommended repairs. When will they be completed? The timeline for that. Deficiencies in the soundness, structural integrity, or habitability of the building's the project's buildings. What are those deficiencies? Any outstanding violations? You've got jurisdictional data here. Does the project have a funding plan? Remember number 6, that's going to come up a little bit later, for deferred maintenance to be completed. In other words, are they setting aside in their budget HOA revenue that can be directed toward deferred maintenance? Reserve study, same with number 8. Is there enough in the HOA's reserves to cover potential deferred maintenance projects that are on the horizon? So you have a significant amount of work now that HOAs now have to do in addition to just the standard condo questionnaire, which talks about number of units and investor concentration and all that other fun stuff. This is all, again, focused on safety, soundness, structural integrity, and habitability. So this is the essentially addendum that is required on all Fannie Mae and all Freddie Mac condo purchases now. Any questions on this form as you guys look this thing over? Okay. So obviously the highlighted area here is deferred maintenance. That's what the issue was at Champlin Towers in Florida, because this was something that they knew about for several years in terms of concrete not necessarily being up to snuff, and the HOA just punted down the road. So deferred maintenance, what does that mean? This is the actual language that is in the new guideline that was released on January 1st by Fannie Mae and Freddie Mac. So if you read this, loans secured by units in condos with significant deferred maintenance or in projects that have received a directive from a regulatory agency or inspection agency to make repairs are not eligible for purchase. What does that mean? That means that if there's significant deferred maintenance that's found as a result of that condo questionnaire that we just looked at, then Fannie Mae and Freddie Mac will not purchase these loans. They'll remain ineligible until the repairs have been made and documented. Acceptable documentation includes satisfactory engineering or inspection report, certificate of occupancy, or other substantially similar documentation that shows that the repairs have been completed. So what is significant deferred maintenance, right? And this is some gray area that is involved. One of the things that the guidance from Fannie and Freddie specifically makes mention of is whether the repairs required evacuation of the building for more than a week. So that is one bright line test that is explicitly spelled out in the guidance. Bullet point number 2, deficiencies, defects, substantial damage, or deferred maintenance that is severe enough to affect the safety, soundness, structural integrity, habitability of improvements. Well, that's rather vague. The improvements need substantial repairs and rehab, including major components, and then something that would impede the safe and sound functioning of one or more of the building's major structural or mechanical elements, including but not limited to the foundation, roof, load-bearing structures, electrical, HVAC, or plumbing. Now, it's important to note that this does draw a distinction between deferred maintenance that is severe, for lack of a better word, and something where maybe there was a fire in a condo unit, or maybe you have an isolated leaky pipe, for example. Those are not substantial deferred maintenance examples that are going to come up either in that condo questionnaire addendum or in, anything else that's involved in the actual condo underwriting process. So it's not like anything that goes wrong with a particular condo or HOA is all lumped into deferred maintenance, because you are going to have regular maintenance that is involved that is just part of the wear and tear. It's when you have these examples of more severe deficiencies that problems may arise with Fannie Mae and Freddie Mac loans. Again, if you don't follow, you're not alone, because the reality is that all of that direct language that I just took directly from Fannie Mae and Freddie Mac is so ambiguous. I mean, there's so much ambiguity. It's so vague that you can see a situation where one loan on a condo is approved by one lender and not approved by another, because it matters, A, how the HOA is filling out that condo questionnaire addendum, and then number 2, how underwriting is going to determine what qualifies as substantial deficiencies with the project, right? One addition to this is that any kind of special assessment that is noted by the HOA or on the purchase agreement or noted in the appraisal absolutely has to be examined by underwriting. So if you have a special assessment that the HOA has put forth, then lenders, underwriters are going to scrutinize that. And they are going to determine, back to that kind of initial addendum, whether enough funds are being set aside by the HOA to actually do that project for deferred maintenance. It's actually one of the most probably severe consequences of these guidelines, in that associations are now at risk of loans not being approved, which means Fannie Freddie say no, if they're not allocating 10+% of the actual budget toward reserves. Why is that? Well, because they're essentially trying to encourage HOAs to save for special assessment or deferred maintenance projects, okay? Before we go on, I want to look at one interpretation of what this looks like, but any questions on what we've covered so far regarding deferred maintenance? Okay, so let's look at an interpretation from Flagstar. Flagstar is a top 5 lender in the US. This is their entire condo guideline, where they are talking about temporary requirements. There's more vague language in here, but you will see that special assessments is one area that they have significantly highlighted. So if you are a listing agent or a buyer's agent on a condo, special assessments is something that you should absolutely be aware of up front. You'll see the language here. They are asking for the reason, the total amount assessed, the total amount that is an appropriate allocation, or if there's adequate cash flow to fund that special assessment. And then for current special assessments, again, this budgeting guideline, where the amount budgeted year to date has been collected. Now, in order to do that, you're talking about an income statement from the HOA, budgeting documents, things that are, pretty standard in condo disclosures. But a lot of HOAs may not have been budgeting 10% for these areas, and that can cause some significant problems, especially if you have a buyer that has less than 10% down. So even look at Flagstar. This is what is critical repairs. They're struggling with the ambiguity as well, right? They are just simply punting a little bit where it's like significantly affects the safety, soundness, structural integrity, or habitability of the building's projects. Okay, life safety hazards. What is a life safety hazard? That's a great question, right? And that speaks to how you're going to get different answers from different lenders on what they consider significant deferred maintenance. Material deficiencies. Deficiencies which, if left corrected or uncorrected rather, can result in or contribute to critical element or system failure within 1 year. Okay, well, that might be something where, again, if you have an opinion from someone who has visited the property recently, let's say a structural engineer, they might be in a position where they can comment on that, because there's a lot of underwriter discretion that is in here. You look at significant deferred maintenance, advanced physical deterioration. Well, that's subjective. Lack of full operation, increased operating costs, decline in property value. Okay. Now, it will delineate, as I mentioned earlier, between significant deferred maintenance and routine repairs and maintenance. Okay. If you read this guideline, repairs and maintenance that are expected to be completed by the project in the normal course of business and are nominal in cost. Nominal in cost. These are not considered critical, preventative in nature, accomplished with the project's normal operating budget, so outside of that 10% threshold, completed by on-site staff, focused on keeping the project functional and serviceable. Minor deficiencies, $3,000 or less per repair item that do not warrant immediate attention, but require repairs that should be undertaken in the last 12 months. So there's a bright line test in terms of stuff that costs $3,000 or less generally is going to fall into that category that is routine repairs and maintenance and should not flag Fannie Mae and Freddie Mac. So when we talked about, for example, a fire in an individual unit, as long as you're not seeing structural soundness that is tied to the damage in that unit, it's probably going to fall under the umbrella of routine repairs and maintenance. Questions on all of this? Okay. So the too long didn't read portion of this is, how does this affect you, the agent? And how do we prepare buyers for this new condo world that we're living in? Number one, just what it says. Explain that associations must go through their own underwriting process, right? So you've got the standard condo questionnaire, and then you also have this condo addendum that went into effect January 1st. And you say, hey, I know that you have an 800 credit score, and I know that you're putting 50% down. You are a very strong buyer, but it doesn't preclude you from the rules that are set forth that all lenders have to comply with regarding special assessments, deferred maintenance, etc., tied to the association. Okay. Ask the LO, are you aware of what is going on in this space, because I would say a lot of loan officers are not until they get that condo questionnaire back and suddenly the deal is dead. So, asking the LO about these new guidelines, and then also, have you ordered both condo questionnaires? And what is the turnaround time on those documents? The last bullet point I'm just going to read. Buyers should expect inspection appraisal will most likely be required to be completed in a time frame that is earlier than the results of the condo questionnaire. All right. Any of you have tried to get HOA docs in a pinch, you know that it's A, expensive, and B, not always the quickest turnaround time. Okay. You also have HOA representatives that are somewhat concerned about legal liability tied to this. Okay. In researching this presentation, I came across a lot of guidance for HOA representatives that was encouraging them to speak with an attorney about how some of these sections on the condo questionnaire addendum should be filled out, right? Because if they're putting answers in that sheet and then something were to go wrong with that particular condo building, is the HOA representative at fault, right? And so that, plus them sifting through all of this additional guideline, is something that can take a while. So even though you might have the appraisal back or an appraisal waiver and the loan is fully approved and clear to close, you might have HOA docs that take a long time after that can potentially derail the deal. Again, delineating that there is the process of underwriting the buyer and the appraisal, and then there's the condo underwriting process that is entirely separate. Okay. How about sellers? Be in touch with the HOA. I'm sure that if they're a bigger HOA, they are aware of these new guidelines. But if not, you can certainly, give them a form to reference, or encourage the lender to give them a form to reference. The timeline on condos, guys, could take longer than we are used to, right? Maybe it's a 30-day written statement and a 45-day close on condos. Again, it's something that we don't necessarily control, right? The HOA is in charge of getting these documents back to us, and they don't always work on a deadline like we're used to. Explaining to sellers, there's a lot more due diligence now when it comes to selling your condo unit. Okay. Give them this backstory. Talk to them about the condo collapse in Florida, right? And how Fannie Mae and Freddie Mac have put forth these new guidelines that are making it somewhat more challenging for loans to be approved swiftly when it comes to condos and HOAs. The other piece is special assessments, right? So if you can get out in front of that, that is certainly something that can expedite the process, or at least prepare your seller and the buyer, of course, as part of the disclosure process that, hey, this is the special assessment. This is what it's for, right? And then you can get your wheels spinning and get some collab going with the LO to say, hey, I know about these new guidelines. There's a special assessment. They've set aside X number of dollars for it. What do you think? I just want you to be aware of it. Because the last thing you want to do is get a buyer, for example, all the way down the road, pay for an appraisal, et cetera, pay for an inspection, and then something HOA related ends up derailing this part of the process. Okay. Same with a seller. Maybe you have a seller that is contingent, right? I've got to sell my condo so I can buy this new property, right? Being aware of what could potentially go wrong in the process related to these new guidelines. Questions before we jump into some alternatives?
Colin, you want to take a quick look at the chat? Question from
Oh,
Chris.
shoot. Yes, I do. I do
Kristen, is that
indeed.
a cash buyer?
No, he's getting financing.
20% down or more?
20, yeah.
Yeah.
It was Yuri that I tried to send you. But his
So
lender said that he didn't even need to get an appraisal.
correct. So that is a question that is related to an appraisal waiver. Okay. And we've talked about appraisal waivers a little bit here, and maybe that's good fodder for a future Wednesday discussion, but it's not weird. Kristen, what they are referencing is recent sale or refinance data of that condo unit where the condo was sold, let's say in the past 1, 2, 3, 4, 5 years. You know, most recently when it was sold?
I don't know, but there's been several units. Oh, sorry.
Yeah.
There's been
So,
several units.
okay. So what's going on here is that the lender is just putting the loan through Fannie Mae, Freddie Mac, and they are, Fannie Mae and Freddie Mac are saying, yep, we've got recent sale data on that condo unit, and we don't think that we need an appraisal because we see data that supports the purchase price that is current. Okay. So the thought is that that's not weird, but it does not exempt you from, or the lender rather, Kristen, it does not exempt the lender from these two condo questionnaire forms. So yeah, that's great. The appraisal is going to save, I mean, it saves time and it will save the borrower some money. And it, in theory, expedites the underwriting process, but you're still going to need to get, the lender still is going to need to complete these two condo questionnaires. So it's not weird. It's actually a good thing. And something that we do all the time. Jen Edmondson and I put together a deal last night where same kind of thing, condo, no appraisal required. And the listing agent called me this morning and I said, yeah, we're not going to need an appraisal, but are you aware of the association guidelines that Fannie Mae and Freddie Mac have rolled out? Well, no. Now, this is a newer building and I don't see any particular issues here, but planting that seed early is valuable. So, Kristen, it might just be worth you engaging, you know, back to this point on preparing buyers. It might be worth you engaging the LO and saying, hey, have we ordered a condo questionnaire? Make sense?
Yeah. Okay. Thank you.
Yep. Allie, where do things like window replacement and siding replacement fall? Would that be considered deferred maintenance if it is above that $3,000 amount? I think you're fine. Now, the 3,000 is really the only specific quantifiable number that is in all of these guidelines. Okay. You know, does that affect the safety, soundness, structural integrity, or habitability? I don't think so. Right? I mean, just because you're replacing windows and siding does not mean that the building's going to collapse. Right? I think that you would be just fine in that category. To me, that is something that would be would fall under routine maintenance. You know, even if it's more than $3,000. And again, you might have a one. You know, let's say that you have. We've all dealt with properties that look like a townhome, talk like a townhome, and are actually condos because of the way that the developer rolled out that particular development, right? That doesn't mean that, you know, you're going to have significant structural issues with a standalone detached condo, right? I mean, I think about, okay, there are 50 units and you've got a bunch of detached condos and they're doing a siding replacement on all of the condos. All right. I mean, to me, that's not deferred maintenance that affects, back to this here, that does not affect safety, soundness, structural integrity, or habitability. That's just getting the siding and windows done. Does that make sense?
Yes, thank you.
Yep. Okay. So that said, if you run into issues with this, with a buyer that has, for example, 20% down. So Kristen, I'll go back to your example. Okay. Let's say that you have a condo sale where you've got 20% down, this buyer does, and they say the condo questionnaire comes back. It's like, yeah, we've got significant deferred maintenance. We can't do this loan through Fannie Mae, Freddie Mac. There are loans that do not abide by Fannie Mae and Freddie Mac. They're called non-QM options, which again is an area that is growing in this marketplace and will continue to grow, spurred on by this murky condo guidance. Okay, so non-QM loans will only require this questionnaire. This is Angel Oak, for example, which is a significant non-QM player. All right, borrower name, property address, project and unit information, number of units. This is very much in line with a standard condo questionnaire. Okay. They're not talking about anything that is involved with the structural integrity of the building, right? Night and day difference from what we see in that condo questionnaire addendum that Fannie Mae and Freddie Mac rolled out. So they don't go into any of this as part of the non-QM process, right? They do non-warrantable condos in the sense that, 100% investor concentration, you've got litigation, certain rec leases, et cetera. So we've all run into non-warrantable condos before. And for the most part, they've been dead deals because traditional lenders will only sell to Fannie Mae and Freddie Mac, right? Same deal. Okay, we've got an issue with deferred maintenance. All right, well, maybe it's time to look at a non-QM option that can keep the contract in place and get the buyer financed through a non-Fannie Mae, non-Freddie Mac mortgage. Okay. This will come up with condo reserves, right? So, I mean, you look at 10% reserves required. For example, you've got a buyer that's putting 30% down. Fannie Mae, Freddie Mac will flag certain number of reserves for certain projects. Non-QM options will not. Okay. This questionnaire, for example, I'm going to go back to 1 second. It does not make mention of special assessments, right? Whereas Fannie Mae, Freddie Mac's addendum does make mention of special assessments, right? Now, guys, make sure that you don't think that if there's a special assessment for deferred maintenance, it's still going to end up flagged because special assessments are always disclosed on the purchase agreement or by the appraiser, right? So there are just some projects that are not going to fit into the box no matter what. But considering how stringent these new guidelines are, non-QM is a very good niche that we can explore to get 20% down plus condos approved for certain buyers. Some more condo solutions. You have units delinquent. I mean, I've heard so many stories about realtors knocking on doors in condo buildings for delinquent unit owners, asking them to pay their delinquent HOA dues so their buyers or sellers loan can get approved, right? Non-QM has some more guidance on that. They've got more latitude and flexibility we can work within, right? Investor concentration, I mentioned. You've got single entities that are, more than 20% of the total units in the project. Commercial space involved. That's been a big one over the years. That's a 30% threshold as well. So the big takeaway here is just because, Kristen, I'll give you an example. Okay, your lender comes back and says, yeah, we didn't need an appraisal but the condo has deferred maintenance, and we are not going to be able to do this loan. Okay. Doesn't mean it's dead. It just means it's dead with Fannie Mae, Freddie Mac, or it might be dead with Fannie Mae and Freddie Mac with that lender and that lender's interpretation of deferred maintenance. Does that make sense?
Yeah.
I have a question.
Mhm.
Just wondering, with the non-QM loans, like Angel Oak and stuff like that, do they tend to be a little bit more expensive at all for buyers as far as like fees or things like that? And also, are you as a lender able to choose to go non-QM so that you don't have to jump through all the hoops, or how does that work?
Yes, the answer is yes and yes. So non-QM loans are going to be in the ballpark of maybe half a point higher in rate, okay, depending on the actual situation. And as a broker, yes, we have that flexibility. Say, okay, it's not working with this particular lender. Let's go over here and work with, we're going to present the situation to this other lender and see if they have a little bit more open-mindedness regarding the situation. Allie, I'll come back to your situation. Let's say that you're representing a buyer and underwriting is, not getting it. They're saying window replacement and siding, that's something that is deferred maintenance. Well, that just doesn't make any common sense, right? The problem is if you're with a traditional retail lender, you're stuck. They're telling you to go call somebody else and try and get it done elsewhere, right? Whereas in the brokerage model, we would simply take the loan somewhere else and still close it in our channel, right? So that sort of flexibility when it comes to these sort of guidelines can be rather valuable in this model. Any other questions? I know we covered a lot of ground. Hopefully I didn't go too fast. Okay. Well, thank you guys for taking time out. If you have questions along the way or you run into these sort of circumstances, please don't hesitate to reach out to any of us here at Flex. We're more than happy to help.
Thank you, guys.
Thank you.
All right,
Thank
thanks
you much.
everybody.
Thanks, Colin.
Have a good one.
Bye-bye.